What is normal stock market volatility in the S&P 500 since the 1970s? The stock market's averaged 10.83% on an annual basis, but how has it performed over different events and crises during that time? For example, the Yom Kippur War and runaway inflation in the 1970s. In the 1980s, Mexico triggers Latin American debt crisis. Then there was Black Monday on 1987, the Gulf War in 1990, the tech bubble in 2000, the Great Financial Crisis in 2008, and finally COVID in 2020, and most recently is the Trump tariffs 2.0. And let's take a look at that. This chart shows what happens to the S&P 500 on a calendar year basis versus intra-year basis. So for example, in the blue is how the S&P 500 index finished the calendar year, and the gray is how did the stock market perform at its worst time during the year. An example would be if I had $1 million portfolio, to keep numbers easy, and losing 17% is losing $170,000, but finishing positive $260,000 on the positive. So it's a very big swing by being patient. If we look at 1981, minus 18% during the year is what I lost, but I finished at a minus 10%. There's some other years that have larger swings from a negative to positive. For example, 1982, if we look at the gray area, minus 17% was the worst point during the year, but it finished up positive 15%. In dollar terms, on a sample $1 million portfolio, that would mean I lost $170,000 versus I finished the year plus $150,000 on a hypothetical $1 million portfolio. If we look at a different year, 1998, for example, minus 19% during the year at the worst point, but finishing positive 27%. So by getting scared and getting out of the stock market would not have been a profitable strategy, but rather staying in the market, and you would have finished with a plus 27% return. Similar issue happened in 2020 with a minus 34% in approximately 35 days during COVID, but finishing the year plus 19. This is a tremendous U-turn that the stock market made. For example, on a $1 million portfolio, minus 34% is losing $340,000 and then finishing the year actually positive. So you got all your money back plus $190,000 on the positive side. So by being patient, it certainly paid off. If we look at the Trump tariffs 2.0, the stock market dropped approximately 21% on an intraday basis through April 7th and has now clawed back 50% of those losses so far. Where we go from here, hard to say. Building wealth takes time, and my thought is if you think long-term, then you have a better chance of success. For example, in any 1 year period where you invested in the stock market, you were positive 74% of the time. However, if you invested in the stock market for any 10-year period, you were positive 92% of the time. And in over any 20-year period in the stock market, you had a positive return. So the moral of the story is, if you think long-term and have your money continually invested, then your chance of success increases over time. This is investing in the S&P 500 in an unmanaged index over these period of times. Let's take a look at the history of the US bear and bull markets. First of all, what is a bull market? A bull market is defined as the stock market going up by 20% from the prior low. What is a bear market? It's defined as the stock market declining 20% from the most recent high. So when we take a look at the dark blue areas, we can see all the different times we had a bull market since 1942 and all the different times we had a bear market. We can look through history at all the yellow shaded areas to see when the stock market went into a bear market by losing 20% or more. The average bull market going up, lasted 4.2 years, and had a total return of 148%. For example, $1 million grew to $2.48 million over that time period on an average bull market for a gain of $1.4 million. In a bear market, the average length of time it took was 11 months to get through the stock market going down, and it had an average loss of 31%. If we look at a recent period, 2009 to 2020, the stock market grew for 11 years in the bull market for a total of 400%, which was a 15.8% annual return, which means $1 million grew to almost $5 million over that time period. In this next chart, I want to talk about what happens if I missed the best days in the stock market. When I look at the growth of $10,000 invested in the S&P 500 index since 1979, if we left the money in there, it would have grown to $1.5 million. However, if you missed 5 of the best days in the stock market during that time period, your returns would have only been $936K from $10K. So what this illustrates is if you decided the market is bad right now, I think things are gonna get worse, therefore I should get out of the stock market and sell everything because I think it's going to be gloom and doom for the future, therefore I should protect my money, then that would have caused a difference of almost $600,000. If you missed the 10 best days since 1979, your 10 grand would have grown to only 674K, and missing 30 days, your 10 grand grows to 242K, and missing the best 50 days, your 10 grand only grew to 106. So by missing out on the stock market, by being out of the stock market because you thought the conditions are bad, or I think that whatever the current world events are happening, it's going to be horrible, therefore I should take my money out of the stock market, it shows how much this would have been detrimental over this period of time. If we look at the S&P 500 index over the past 98 years since 1926, we can see that the stock market has returned an average of 10.3% per year. If we dissect this on an annual basis of positive versus negative years, you can see we had 72 years it was positive, and the average annual return of the positive years was 21.4%. If we look at the 26 negative years, it had an average annual loss of 13.4%. So 26 years were negative, 72 years were positive. We can look at the magnitude of the different gains and losses. A common question that I often get when the stock market is so volatile, meaning very large moves up or down on a single day, the question is should I be investing money into the stock market? What this chart shows, on any of the worst days, what happened to the stock market if I had invested my money at that time 1 year later. So for example, the average one-day loss was minus 8.85%. And if I invested my money at that point, after that day, what would I look like 1 year later? The average return is 30.29%. If I look 3 years out after that event, the average annual return is 13.17% per year. And an average 5 years later, it's an 11.26% per year, and 10 years, 11.37% per year average. So the thought from my clients is, if it's so volatile, therefore I don't want to invest my new cash because I don't think the stock market knows where it's going, therefore it's uncertain, therefore that's why it's declining so much, therefore I don't want to invest my money. What this chart shows otherwise of that's actually a better time to invest when there's that much uncertainty. And it shows the average annual return by investing money right after those points. When we look at the history of stock market corrections in the S&P 500 index from 1942 to 2024, A 5% loss or more happened 3 times a year on average, lasting 39 days. So a very frequent event and very common to see that during the year. If the stock market declining 10% or more happened on an average once every 16 months and lasted 128 days. So approximately every year and a half is when this occurred. A loss of 15% or more happens once every 3 years on average, and it lasts approximately 230 days. So for example, a 20% decline or more happens once every 5.5 years and lasted approximately 335 days. The moral of the story is market corrections or declines happen on a regular basis, and it's the larger the decline, the longer the time it takes to recover. Let's take a look at some actual events in the stock market and how did the stocks perform during these major events and how long did it take for it to recover back to the same place. In the current Trump tariffs 2.0, the stock market declined 21% on an intraday basis and has been down for approximately 47 days. And we don't know how many days it's going to take to recover, but it's recovered half of the move already. In 2022, during inflation and Fed hiking rates, the stock market dropped 27%, and it took 287 days to go down that 27%. And it took 1.25 years to recover that amount. During COVID, in that 37% decline, it dropped that amount in 34 days and took only 151 days to recover that. During the Trump trade war 1.0 with China in 2018 and the Fed was hiking rates, the stock market dropped 20% in 84 days and quickly made that back in 125 days. Going back to 2011, the US credit rating downgrade from a AAA rating, the stock market dropped over 20% in 89 days and took approximately 134 days to come back. Looking at the great financial crisis in 2008, a 57% decline, 1.4 years to go down 57%. Imagine losing more than half of your invested assets. And it took 4.1 years to get back to even. And then the internet.com blow-ups, the dot bombs in 2000, again dropped over 50%, taking 2.5 years to decline and over 4 years to come back to the same place. And in 1990, when Iraq invaded Kuwait, there was a 20% decline over 88 days, and it took approximately 124 days to get back to even. So what this shows is kind of the larger the decline, then the longer the period the stock market took to recover those losses. And when the magnitude was shorter, sometimes it recovered faster. To wrap up, we've discussed all the different major stock market events that's happened over the last 50 years. We've examined the magnitude of each decline, as well as how many days it took to recover, and being invested versus getting out, getting back in. Does that strategy work, or is it better to stay invested? If you've enjoyed the video today, hit the subscribe button to get more content sent to you on a regular basis, and hit the like button. Thanks.